Hello and welcome back to Invest with Humility. My name is Bruno, and this time we'll be covering loan overview, and we'll take a look to how loan operates on your retirement account. So these features will be similar on your 401 and your 457 account. Um, this goes without saying, loans are not allowed on your IRA, so the loan option is not there. So, what should you be aware of when it comes to loaning your retirement account? First thing you should know is that your employer decides on whether they want to allow the loan option to be available on your retirement account or not. They also control if they want to add any restrictions for you to request a loan, either if it's a hardship, and in some cases, they may even specify which type of hardship you can request a loan for. Um, I know, but it's their choice. Or they could simply just allow you to request a loan for any purpose. Now, you may be speaking with some of your colleagues who work in a different company and they tell you, hey, I'm able to request a loan from my retirement account. I think you should be able to do the same. Please keep in mind your employer makes the decision on whether or not you can request a loan. So it's best for you to reach out to your employer, and ask them if they do allow that option. Or you can call the record keeping company and they can tell you if you have the loan option or not. All right. The other thing you should know is that double taxation, and I'll bring this point as we go on, on the loan guidelines and as explain the loan process. Please keep in mind, when you request a loan towards your retirement account, you're requesting the funds and you're paying the loan back with interest with after-tax dollars. So the loan is taken from your retirement, you're repaying back the loan and interest using after tax dollars. So let's say requested 5,000, you will be repaying 5,000, and the interest rate right now is almost like about 7% for like regular loans, conventional loans and the retirement plans. So you'll be paying all those funds towards with after tax dollars. And in the future, when you come to withdraw that balance, you're also going to pay tax. So that's why we say double taxation. So again, if this is your last option and you want to exhaust it regardless, I cannot tell you what to do. I can only give you all the facts, and you can make your decision on whether if you want to proceed to request a loan towards your retirement account or not. But essentially you'll be paying double taxation on the funds. And that goes without saying that once you pull out the funds, those funds are no longer invested, so they are not growing. Even though when you put back the money, the funds are invested to the investments that you allocated initially, and you can change the investments. But for the duration, let's say 5 years, if it's just a regular loan that you've taken, those funds are not growing. Okay, so I hope that is clear. Um, the other concept that I want to bring out now is deemed loan. Now, deemed loan, this is when you have not made a loan payment for a significant amount of time. For some record keeping companies, they may tell you if you do not make a payment within 90 days, then the loan will become deemed, and at that point, it will become taxable. When a loan becomes deemed, it cannot be reversed, meaning at that point you have to pay taxes towards the remaining balance. Even if you repay back the loan, that doesn't remove the taxation part of it. So keep those things in mind. You also won't be able to request a new loan until that loan has been paid off or you've covered the deemed loan. Okay. Again, please feel free to leave any questions that you may have below. I'll be happy to get in the comments and answer any questions that you may have. So let's dive right in. Loan features. So most plans allow loans to be taken or refinanced only once per calendar year. So you can review the plan features. You can go to your employer and you can, go to their website and they can tell you more about the plan features that they offer. But typically that's what you should expect. You can request one loan, and sometimes you may get an option to refinance it in the future, you know or in some cases, for most loans they will allow you to refinance. In some cases they will not, but essentially when you're refinancing, you're requesting for more money. So um, it's really important, if you request a loan towards your account, you request actually the amount that you need. Please keep in mind you can only borrow up to 50% of your vested balance, and the amount cannot exceed 50,000. So the cumulative loan balance that you have had in the last 12 months cannot exceed 50,000. So please keep those things in mind. Now, you also cannot request lower than 1,000. Um, so when you're paying back the loan, you're paying the loan with the interest, based on the balance that you have taken. And in some cases, you may have a lot of funds towards your account. You may not be able to borrow the entire 50,000. And the reason for that is if you had a loan balance in the past 12 months. So please keep in mind the cumulative loan balance you held in the past 12 months is taken into consideration. I hope that is clear. If you have any questions, again, please feel free to leave them. I'll be happy to respond to them. Your plan may permit either a single outstanding loan or multiple loans to be outstanding at the particular time that you have. All right. Now, there are two types of loans that your plan would offer if your employer has. So the most common ones are either conventional, also referred as personal loan, which has a maximum of 5 years, and a residential loan. This is like a mortgage loan, but it's primarily for the purchase of your primary residence. If you're not going to purchase your primary residence, please do not request this loan. You may want to speak to your tax advisor before requesting this loan, because you may incur some tax consequences. It specifically says only for the purchase of your primary residence. And for these types of loans, you can request them for a 15 to 30 year time frame. Okay. Not for most plans, if a participant refinances the loan and pays off in the same year, they cannot take another loan. So please keep those things in mind. All right. Next, we'll go to refinancing. So refinancing allows you to request more funds towards your existing loan. And typically, you cannot refinance until 1 year has passed since you have requested for that loan. So essentially, you'll just be requesting more funds, when you're refinancing the loan. Now, you also have an option to reamortize your loan. Let's say you are out of work for a particular period and you're coming back, you want to reamortize your loan, with your payment. If your employer allows you to reamortize the loan, or, they allowed you to be able to suspend the loan and then restart the payments, which I must say that is not a common case. But if they do allow you, then you can go ahead and reamortize. You can also reamortize to change the terms of the loan. That means if, for example, you had a high interest rate, for example, now the interest rate is about, northwards of about 7%. Let's say in the future, in a year or two, let's say the interest rate comes down and you decide you want to reamortize to get a lower interest rate, you can do that. Let's say you requested a loan, with a conventional loan which has a 5-year time period, and you decided that you only wanted the loan to be for 3 years. Life happens, you have some bills now, and you want to extend the loan to the maximum length of time that you can reamortize the loan and get the full length. Many institutions will charge you fees, that goes without saying, for requesting a loan towards your account, refinancing, or reamortizing. And also there may be an annual fee. So keep those things in mind when you're requesting loans on your account. All right. And lastly, we'll cover the loan mechanics. So what you need to know. Again, as we have discussed, the maximum that you can borrow from your retirement plan is 50,000 or 50% of your vested balance. So either one of the two, it cannot be greater than that. But even though you have, the amount that you can borrow up to 50,000, again, with the cumulative loan balance that you have had in the last 12 months is taken into consideration. So if you still had a balance within the last 12 months, and you want to request 50,000, even though you have those funds in your account, you will not be able to request that much amount. Okay. Payoffs. If when you decide to pay off the loan, you can pay it off at any time. There are no any penalties. Also, please keep in mind that retirement plan loans have no relation with the credit bureau or your credit score. So these loans are towards your retirement plan only. So you do not have to worry if you do not have a good credit when you're coming to request these loans or not. Your credit is not pulled. Typically, it's just based on the amount that you have on your account. All right, dimmed loans. So repayments over. So as we discussed, dim loans. This is when you have not made a payment for like a significant amount of time that you're supposed to make a payment. For some companies it could be 90 days. It just depends. Then your loan become deemed. At that point, you will not be able to repay your loan at regular payments. You're going to receive a 1099 and you'll have to pay taxes on the amount. Now, even if you repay the loan back in full, that won't remove the taxation amount. And please keep in mind, if you requested a loan from a 401 account, that means you're going to, if you're below 59 and a half, you may incur an early withdrawal penalty. So in addition to the taxes that you have to pay, you will also have to pay early withdrawal penalty. And the reason for that is because that default payment is treated as a withdrawal. So please keep in mind when you take the loan, that is what you're opening yourself to. So again, when you fail to pay the loan, you will also not be able to request a new loan in the future until that loan is satisfied. And you may have, your employer, feeling some type of way with you because you took the loan towards your retirement account and you didn't repay it. It's not like that in most cases, but it could happen. So again, when you take a loan towards your retirement account, make sure it's the last option you have exhausted. Speak to a financial advisor if you have one, and know what you're getting yourself into. Again, I added this last point here, the tax impact we have already discussed. Again, you're borrowing the funds and you're repaying them with after-tax dollars, meaning after taxes have been taken from your paycheck, you're using that money to repay back the loan. And even though the payment and the interest is going to be reinvested back into your plan, when you withdraw the money in the future, that money is also going to be taxed and penalized. Sorry, it's going to be taxed again, so it will be double taxation. So keep those things in mind. If a loan is the right option for you, go ahead, but you may want to exhaust other options such as withdrawals, emergency withdrawals, or hardship withdrawals. We'll discuss withdrawals in the upcoming videos. I hope you enjoyed this session on loans. Tell me what you think about it. If you have any questions, leave them below. Thank you all and be blessed.